Hi, everyone. Welcome back to the InvestPaul podcast. Today's guest is Noah Damsky. Noah is the founder of Marina Wealth Advisors. And prior to launching his own wealth firm, Noah's worked at a variety of different financial companies, ranging from pension funds, private equity, private credit, and VC. Noah, welcome to the show.
Hey, Cam, thanks.
So, Noah, I know you and I have gotten to know each other the past, I guess, close to a year now. I'm curious, for everyone listening, can you walk us through a bit about your background and why you wanted to launch Marina?
Yeah. So in the past, I've worked at firms like PIMCO and Bessemer Trust on the client side. Went to business school to UCLA, and then from there, I started working at the Los Angeles County Pension Fund, or LACERA. And before I started at LACERA, when I was in business school, COVID hit, and recruitment dried up, and I realized I might need a plan B. And I always had starting my firm in the back of my head. And when COVID happened, recruitment dried up. I said, you know what, this is a better time than ever. So I started the firm then, and then I got the offer from LACERA, and I said thanks, but no thanks. And it's different when you work at the government. You just have to disclose any outside business, and otherwise you're good to go. It's different than working in the private sector. So the stars kind of aligned in terms of being able to start my career at the pension fund and working in private equity, and also launching my firm as well.
Yeah, very interesting. And so I know, based on this background, we've had a few guests on who I'd say are on the opposite side of the alts spectrum, the private equity spectrum, where they are the fund managers or they're helping with distribution. But I think you bring a unique lens where you had that industry experience and now you're helping clients get access to it. And we've seen such a big drive, a big interest into the alternative investing landscape, which is a catch-all term for basically anything that's not public. But I'm curious, what do you think is driving this trend right now towards a rise in alternative investing?
Yeah, so I think we've seen the public markets, like the number of stocks, shrink over the years, and the rise in opportunities in private markets. So I think structurally, there's more opportunities in private than in the past. I think also from a business perspective, I think that's a higher margin area of the market. So I think some of the large players in the industry have naturally pushed their business into the alternative space. So I think it's just made a lot of sense in terms of market opportunity, and then business opportunity for funds. And I think this has created an opportunity for clients and investors as well.
So on that note, do you find, with the trend of companies staying private for longer, when you think about alts as the more interesting opportunity within the private market, the non-publicly listed owners, meaning like I would exclude like hedge funds from when I'm evaluating any sort of private funds for my clients?
Yeah, I think the growing opportunity, it feels like it's more on the private equity side as opposed to the public areas of alternatives like hedge funds. So I think private equity, private credit, those really seem to be driving the interest in private markets, and especially with advisors and their clients.
Okay. So when you think about evaluating a private asset or private equity investment, or private equity fund, um, what do you look to deploy or what do you research behind those potential investments, and how does that end up differing from a public equity investment?
Sure. So I think one of the first areas that you have to start is, just from a regulatory perspective, is some opportunities are for qualified investors, some are for qualified purchasers. Those have different income or net worth thresholds. So some clients might not be they might not be allowed to invest in either. Some might be allowed to invest in one but not the other. And I think just the fit for the client. even if they do qualify to invest in some of these opportunities, like, is it actually an opportunity that they should be looking at? And I think one of the biggest barriers is looking at liquidity. So some of the options in the market are quarterly liquidity funds, and some are drawdown funds, which have 10 to 12 year lives. So for some clients, depending on their net worth, their time horizon, their age, it might just make those easy decisions to cross them off their list, just because of the lockups.
Okay, interesting. And then how would like diversification factor in? Because like when I think about investing on the public market side, I'm looking at like sector, geographic exposure. Like what are the nuances on a private investment you'd have to consider from a diversification lens?
Yeah, so I think the way that you talked about it, just in terms of overall portfolio construction, sector, geography, I think you have to apply those same principles to private markets as well. The way I apply it is that I like to think of that sector exposure not just within the alternatives bucket, but also in the private markets bucket. So let's say that a client of ours is investing in a drawdown private equity vehicle that's focused on technology. Well, when we fund the capital calls for that, we'll likely take down exposure from public markets technology to increase exposure to private markets technology. So their overall sector exposure isn't going to change. So I think you have to be thoughtful about how you take a whole portfolio view rather than just looking at alts as a very narrow bucket. You got to look at everything as one.
Okay. And you mentioned an interesting point previously on the liquidity side. When you're evaluating a private market investment, is it primarily focused in on the required cash flow needs from my client versus like the public market might be more like overall capital growth?
Yeah, so I think some clients might focus on one aspect more than the other. So, if you're looking at private markets opportunities that are primarily focused on yield generation, then cash flow might be more of a driving factor. Whereas if you're looking at a drawdown 10, 12-year fund in private equity or venture capital, it's going to be more growth focused. So I think there's different flavors for different people and what they're looking for. Some of those opportunities I might gravitate to more so than others. I think there might be some structural limitations in the market, just lack of transparency that makes some areas just harder to get my arms around than others. So I think you have to take all that into account, what the client's looking for, and really what you think you can get your arms around and actually advise them in the best way.
Okay, that makes sense. And then talking more on the due diligence side, 'cause we had an interesting conversation last time around this, where researching a public equity security is, I think, very different than evaluating a private fund manager. So, what are some of the considerations you look at on evaluating that fund manager?
Sure. So I think there's a laundry list of things that you would do, but I think there are some really actionable steps that advisors can take when they're looking at these opportunities as sort of their initial pass, as their first screen. So I think one of the most applicable skills that advisors can learn is to evaluate realized versus unrealized returns. And I think this is particularly relevant for drawdown vehicles with multiple fund track records. Realized returns are better. They're money in the bank. They're not assumptions. They're a done deal. Unrealized returns, I think of in some ways as hopes and dreams. If there isn't an exit, then it's hard to put a lot of weight into unrealized returns since they're still in progress. And that makes it hard to evaluate any manager's first fund or even their second fund where realizations are non-existent or limited. So you really start seeing exits by, call it fund three. And even then, you need to compare those returns against peers. So if someone tells you their stock portfolio returned 20% a year, it sounds good on the surface, but what if the benchmark was up 30%? Then relatively that 20% might actually be bad. So getting this data, that can be tough because it can require subscriptions of services like Burgess that aggregate that benchmark information. And sometimes even if you do have it, it can be worthless. When I worked on the infrastructure side, um, the infrastructure industry benchmark, it wasn't very helpful because it would lump all deals together. I think the infrastructure benchmark, it's a smaller space than an area like private equity, so the benchmark is a bit wider. Um, so the benchmark has core funds that return single digits, higher risk funds that return 20% plus, and they're all sloshing around the same benchmark. So in infrastructure, it's really not that helpful because you're not always comparing apples and oranges. You're not always comparing apples to apples. It can be apples to oranges, and it's really hard to evaluate one versus the other. So you actually have to understand the deals and the market environment to know how relative performance stacks up. But I think the first step is really just focusing on realized and unrealized returns.
On that note, is there a trend more recently with that? These companies that the private equity businesses might be owning now are remaining private. That there's more and more unrealized gains being reflected in fund performance.
Yeah, I think so. One aspect that we're starting to see more and more of is continuation vehicles, and that's when a fund is nearing the end of its life and it has to wind down. It has assets that the GP doesn't necessarily want to sell for one reason or another, so they put it into this separate vehicle that existing investors can opt into, opt out of. It's a way to keep exposure to assets within a fund as the fund winds down. And I think there are some pros and cons to that. You definitely have to be careful, as it can be a bit of a landmine. But it's certainly something that we're starting to see more of. Um, but I think another area that advisors can apply right now is understanding, I think, the trends and how GPs might mark their returns. So when I was at Lacera and I was evaluating different managers, one thing I noticed with some GPs is that they'd mark up their unrealized returns in their most recent fund when they were fundraising for the next fund. So it made the prior fund look good when they were fundraising. Then later on, as the fundraise would wrap up, the prior fund realizations began, and the returns weren't always as rosy as they might have seemed when the returns were unrealized. So if you map out how that IRR was marked over time on a quarterly basis, you'd see it go up through year 4 or so, which covered the fundraise for the next fund. Then, as realizations started to come through, the returns would magically sort of flatten out. So it was I think it was a bit of gamesmanship by the GP that helped to cross those off my list. It's really just mapping out quarterly returns data, so you can probably get that from the manager if you ask. But I think that's another example of how advisors can really weed opportunities out and avoid those landmines for clients without needing to have access to the most sophisticated and the deepest data that maybe they just don't have access to. I think these are areas that they can actually focus on.
Yeah, that part I find very fascinating. And I'm curious, do you think that ended up not the main contributing factor, but maybe one of the factors in that 2022 crunch where a lot of those very hot startups in the VC world took massive markdowns? There's finally a come to Jesus moment where those funds they were bumping up valuations for their portcos, and they then had to finally come to terms and write a lot of those investments, those unrealized gains down.
Yeah, I think that can definitely happen. Um, I think folks are quicker to mark things up than they are to mark things down. You're always going to hold out hope that they can grow into the valuation. Something clicks later on, the market comes around, something changes for the better. So I think there's always that hope. but marking things down before you have to, you might be shooting yourself in the foot. So I do think some of those markdowns uh, they come later on, and the returns that you're looking at, those unrealized returns, they might not necessarily be as rosy as they seem right now when they actually sell those assets.
Yeah, that's fascinating. Is that across the industry, or do you see that within like a particular subset, like within private equity more than you do within like infrastructure?
Yeah, so I wouldn't say it's a common thing that I saw. I don't want to be too conspiracy theory-ish and make it sound like these things are rampant in the industry. Um, but sometimes they happen. You got to be on your toes, and I think you got to go the extra mile, and sometimes look at things from the perspective of the GP and what might be favorable to them, and putting yourself in those shoes and trying to figure out if you can back into some of these things that they might be doing. And I think most aren't doing that, but some do. And you don't want to be the advisor that puts your client into an opportunity where they're playing those kinds of games, because there's probably going to be other landmines that come up later on, and it might really blow things up for your client's portfolio. So I think it's diligence is all about trying to turn over stones where you can find different risks and opportunities. And most of the time, things might look very kosher, and they might be as you would hope and expect. But sometimes you find some ugly things, and it's just necessary work to do.
Absolutely. So on the note on evaluating the manager, I've heard. I'm talking. I don't deal really in the PE space at all, but on the VC space, I had an anecdote from a friend who was saying he deployed some capital as an LP into a venture capital fund. And while typically it'd be like a 3 to 5 year capital call schedule to get that money in the door, they mandated all of the money up front, but then they never invested in any companies because they were earning 3 to 5% annualized just on the interest that they put that cash into, and they make 2% on top of that as well. And I believe they structured it. It might be common or it might not be common, but they take home all of that income. They don't. That's not factored into the returns. Have you seen in more recent years with higher interest rates that these companies, these funds are not actually deploying capital? They're calling capital, but they're not actually doing anything with it?
Yeah, so I think if you see something like that, it's probably on the I'd call it like more of a startup fund, maybe more of a garage band fund, where it's not quite like as institutionalized as some of the larger managers. I think, like, if I put my Lacera hat on, there's no way I'm going to deploy uh, you know tens of millions or hundreds of millions of dollars into an opportunity where they're running things that way. I think the the blue chip way to do it is you call capital when you need the capital. One, I think that's what investors would expect. I think it's best for investors. You let them keep their capital for as long as they can until you actually need to deploy it. But also, it's good business for the GP too, because you don't want to have to call capital and not use it, because what that does is it affects your IRR. If you have cash and you're sitting on the cash, you might be earning 4 or 5% on cash today, but your hurdle might be 8 to 10%. Your expected returns, especially in venture, are 25, 30%. They're pretty high. They're a lot higher than cash. So the last thing I'd want to do as a venture manager is to call capital and sit on it, because it's just going to destroy the returns for that fund. So I think putting on that institutional lens and evaluating these opportunities from that perspective, I think is really valuable, because in the case that you're talking about, I think you're investing in something that to me feels a little more garage band like. It's not as institutionalized, and if they're doing things like that, some of the other processes probably aren't very buttoned up, and I think you're you're walking across a field that's ridden with landmines, and even if you avoid one for the first couple steps, you're probably going to step on one pretty soon, and things aren't going to go well. Some of the things that I've seen in the venture space that I would call that are more emerging managers that haven't fully institutionalized their processes. And one thing is, like you were talking about, they're calling capital prematurely, and a lot of that comes from when you're investing with when retail investors or your LPs. They might not send capital when you actually need it, like an institution would do. They send it later on, so people have to call capital up front. I've seen that happen, and that's definitely that's damaging to returns, and I think the quality of the fund. But one area that I've seen too is in some venture funds, uh, you might have a scenario where investors invest at different closes. So you might have a first close, you might get some initial capital in the door, and then a year later you might be closing your fundraise, and capital comes in the door on the back end like a year later. Well, an institutional uh, an institutional manager is going to they're going to sort of normalize those investments over time by charging the later investors like an interest rate, because you don't want investors that come in at the beginning to bear the cost of starting up the fund and making those initial investments, then having investors come at the end um, and invest and sort of have the initial investors fund that initial period. So uh, some VC funds I've seen where they don't charge an interest rate to investors that come later. And I think that's a mistake because you're not going to capture high quality institutional investors that write bigger checks that are going to know to keep an eye out for these things. Or if you do, they're going to game the system and come in at the very end, and they're going to let the retail investors, the unsuspecting retail investors, invest the capital early, get the fund off the ground, make those initial investments, and then they'll come in later if they like how the fund looks so far, and so they don't have to pay that interest rate. So I think that's another thing that you want to look out for, and it's not necessarily be the later investor and sort of not have to pay the interest rate. I think that's a very transactional way to look at it. I think it's try to invest with folks that have these processes buttoned up so that you don't step on those landmines when it comes to other processes that might not be buttoned up. And I've seen this in first time managers where they have it in their first fund and then they button it up when it comes to their second fund. So they're clearly improving. They're getting better processes, but I think that's an example of how investors might be setting themselves up for tricky situations and tricky opportunities that might not have those best practices built out.
Very interesting. Okay, one last question for you. There's been talks that we're in a PE bubble. What do you think the future holds for the alt side? Do you think it's going to continue accelerating and growing, or do you think we're at that inflection point where there's going to be a pushback to the public markets now?
Man, Cam, I wish I knew the answer to that. I'd be sitting on a beach right now instead of chatting with you if I knew the answer to that. But um, I think we've been concerned that markets overall are in a bubble for a long time. We've heard this about public equities for I don't know 10 years now. Ever since the recovery from the GFC, we seem to hear it all the time. So I'm always worried that there's some sort of bubble out there. I'm not really sure that it's specific to private markets. If there is one, it might be in private markets, but it might just be in equities broadly. I don't know, but I don't necessarily buy into those. This is the time when things are about to melt down. I don't like to top tick. Feel like you can be wrong for a long time, and then you can be right, and you think it kind of vindicates your perspective, but I don't think it really does. I think it's really hard to know when those scenarios are actually going to happen. So I think there's just a lot of liquidity out there. in the markets broadly. I think there's a lot of growth. I think there's a lot of technological change that's driving markets in general. So sure, there might be a lot of capital sloshing around, but to think that all that capital is creating this bubble, um, I'm hard pressed to think that and prepare for that when I invest.
Okay, fair point. I mean, my red flag is what we saw in the SPAC craze when you start getting random celebrities launching SPACs. You probably know the retail market's overhyped, and I wonder if there'll be something similar on the alternative space when there's people in the industry of no business being in there, creating their own funds and launching it. That would be like my big red herring to de-risk.
Yeah, and I think those things pop up along the way, right? Like we saw stupid SPACs. We see funds get started by people that probably shouldn't start funds. We see people buying Dogecoin to the moon. I mean, like these things happen along the way. It doesn't necessarily mean there's an impending collapse. I think there's anytime you have a lot of capital sloshing around, like there's always going to be stupid opportunities to put that capital into, and you just have to be disciplined and a discerning investor and say like, hey, there might not be a lot of intrinsic value to Dogecoin. Like maybe I'm not going to touch this. Um, but those things happen. I think they'll continue to happen. You got to be disciplined and just put on your your diligence hat and like just see if these things sound reasonable. I think a lot of these things, looking back, we say like, yeah, that was pretty stupid. Like there was no reason for this person to be raising capital and starting a fund. There's no reason to be investing in what was it? Was it um,
I mean, I think if Kim Kardashian launching a fund is like red flag.
yeah, like that could be a red flag. Um, but the VR or the AR real estate, I remember like the digital real estate
Oh yeah, metaverse.
yeah, the
Yeah,
metaverse real estate. Um, I mean, I don't know. It sounded pretty ridiculous at the time, and I think looking back now we know that was pretty ridiculous. So you just got to think about things reasonably and say, does it sound like a gimmick or does this actually sound like an opportunity?
yeah. You're talking to a Roblox bag holder from 2 years ago, so I feel that pain very acutely. All right, Noah. I really enjoyed this conversation today. Where's the best place people can get in contact with you?
Yeah. So I can check out our website, marinawealthadvisors.com. Um, Fill out the form, shoot me a note. Yeah, happy to chat with folks that are kind of thinking about how to dip their toe in the alt space. If I can be of help, always happy to pay it forward.
Wonderful. All right, Noah. Thank you so much.
All right. Thanks, Cam. See ya.